This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the PlanetMicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in to the PlanetMicroCap Podcast. You can follow the podcast on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 22. For this episode of the PlanetMicroCap Podcast, I spoke with Adam J. Epstein, founder of Third CreekAdvisors, LLC. Mr. Epstein is a well-known speaker on corporate governance and the author of the best-selling resource created specifically for small-cap corporate directors titled The Perfect Corporate Board, a handbook for mastering the unique challenges of small-cap companies. As defined by Investopedia, corporate governance, and I quote, is the system of rules, practices, and processes by which a company is directed and controlled. Corporate governance essentially involves balancing the interests of the many stakeholders in a company. These include shareholders, management, customers, suppliers, financiers, government, and the community. Since corporate governance also provides the framework for attaining a company's objectives, it encompasses practically every sphere of management from action plans and internal controls to performance measurement and corporate disclosure, end quote. You can probably imagine the implications of having good or bad corporate governance in a microcap company. The goal for this episode is to learn about and define corporate governance, understand why this is important when doing your due diligence, and what we can do as investors to better know what we're getting on the corporate governance front in microcap companies. Thank you again for tuning in to episode 22 of the PlanetMicroCap Podcast. Please enjoy my interview with Adam J. Epstein, but first, a word from our sponsor.
A comprehensive streaming of market data, research, and portfolio management application for you. QuoteStream is a real-time streaming quotes and research system designed for the day trader, retail investor, institutional investor, both new and old. QuoteStream offers low latency, tick-by-tick data, advanced charting, comprehensive technical analysis, news, and research. With no software to install and no servers to maintain, QuoteStream is the ideal solution for you. Go to stocknewsnow.com and start your free 7-day trial. Click the QuoteStream banner in the header or real-time quotes in the nav bar to get started building and managing your investments.
For this episode of the PlanetMicroCap Podcast, I have Adam J. Epstein, founder of Third CreekAdvisors, LLC, on the program. Adam, welcome to the PlanetMicroCap Podcast.
Hey, Bobby. Thanks for having me.
It's my pleasure. So as we usually start off with every interview, I want to first start off with a little bit about your background and how you got into microcaps.
Sure. Happy to. I started my career as a lawyer at a large law firm in San Francisco, and I think I pretty quickly realized that selling time wasn't a great way to make a living. So I spent the next 10 years in operating roles in retail and technology and merchant banking, and like a lot of entrepreneurs, some of those were successful, some of them less so, and also like a lot of entrepreneurs, I definitely learned quite a bit more from the unsuccessful ones, but they sure didn't feel great at the time. But thereafter, I was one of the 3 co-founders of Enable Capital Management, which is also in San Francisco. Enable operated several special situation hedge funds, and during the 2000s, our funds were certainly among the largest, most active special situation hedge funds in the United States, and we invested hundreds of millions of dollars in more than 500 small cap financings, and I still have all the notebooks and gray hairs to show for it. And when I left Enable in 2009, I founded Third CreekAdvisors, and Third Creek happily. Hopefully there's no Hart-Scott-Rodino lawyers listening, but Third Creek is happily somewhat of a monopoly in that I'm the only former institutional investor that advises pre-IPO and small cap companies how to navigate all of the kind of unique, critical boardroom issues that institutional investors care most about. And it's It's interesting, Bobby, that after I left Enable, I spent quite a bit of time speaking to some of our former portfolio companies and a mixture of micro and small cap companies to understand how they navigated a lot of the critical capital markets and corporate finance issues that small public companies face. And what became pretty clear to me pretty quickly was that these were really smart people in the C-suites and boardrooms of these companies who were struggling with what I would characterize as a pretty complex three-dimensional chessboard of issues. And to make matters worse, they were victims in some sense of a pretty poignant disconnect. And what I mean by that is, look, whether we all want to agree it should be this way or not, the efficacy of all of the boardroom decision-making that goes on in public companies in the United States is evaluated really by one principal constituency, right, in the capital markets, and that's institutional investors. And yet all the people in all of these boardrooms and all of their advisors in small public companies, with very few exceptions, by the way, all share kind of one critical thing in common, and that is that none of them have ever been institutional investors. And so, put a little differently, there's an awful lot of guessing going on in the majority of public companies, which of course are micro and small cap companies, about how institutional investors are going to react to all of their critical boardroom decisions. And I think another part of this kind of systemic disconnect is that not only is the most important viewpoint missing from most of these boardrooms, i.e. that of institutional investors, but the advice that's given to a lot of these boards is often, frankly, pretty conflicted advice. That is, that firms that are giving all kinds of advice, a lot of that advice often serves their purposes more than the interest of shareholders. So, I think in fairness to all the CEOs and boards, there's never actually been, believe it or not, an objective resource for them to use to kind of analyze all of these issues from the perspective, again, of institutional investors. And I tried to solve that problem by writing the only book that's ever really been written about all these issues. And in 2012, the end of 2012, McGraw-Hill in New York was gracious enough to publish The Perfect Corporate Board, which is basically a handbook for mastering all the unique challenges that these companies face. And I don't know if you've ever written a book, Bobby, but it's sufficiently arduous process that I think I'm definitely one and done, if you will, on the book front. That said, I've been pretty humbled, really, by the reception to the book around the world. In April of last year, it was actually the #2 corporate governance book on all of Amazon, even a couple of years after being published. And so overall, a terrific experience. And incidentally, whenever I mention the book, and a lot of people who have heard me speak have heard this, but I always like to mention that unlike a lot of people who promote their books and who are writers and speakers and advisors, I actually don't make a nickel from the book. I donate all the royalties to a charity called Fisher House Foundation, and in my opinion, Fisher House does a terrific job helping U.S. veterans and their families. And so, just last couple of comments just on, kind of how I got here. I think in support of the book and frankly, just in furtherance, really, of discussing many of these issues in the light of day. I've probably given 70 or so keynote speeches all over the world in the last few years, and it's been a pretty amazing learning experience to hear the perspectives of so many smart capital markets and corporate governance experts from around the world. And in addition to the speaking, I write the only small cap focused corporate governance magazine column in the U.S. I think it might be the only one in the world, but definitely the only one in the U.S., which is for the largest corporate governance publication called Directorship Magazine. And I'm on the teaching faculty of the National Association of Corporate Directors, which is the largest governance organization in the world. And for those of you out there who operate or govern NASDAQ-listed companies, I'm also one of the key contributors to NASDAQ's new small-cap content platform, which is called Amplify. And so if any of you are listening that are NASDAQ issuers would like to see any specific issues addressed going forward, feel free to shoot me an email. So anyway, I hope that covers your question. That's definitely more than enough about me.
No, you know what? Interview over. I'm just kidding. And by the way, I've written a few table of contents in my life, and I'm very proud of them. Hopefully the book will come soon after. But
stick to that. Stick to the table of contents. It's a lot easier.
So, okay, there's a lot there. I want to unpack it a little bit because you mentioned a few of these things, but let's get into the nitty-gritty. Could you describe in a little more detail for everyone what kinds of issues Third CreekAdvisors helps pre-IPO and microcap companies with?
Yeah, sure. I mean, obviously having co-managed funds that invested in, more than 500 micro and small cap financings, I had a kind of a front row seat, if you will, to a lot of the capital markets and corporate finance mistakes that these companies make. And as institutional investors, we certainly benefited from a lot of those corporate finance mistakes, but also we suffered from them for sure. So I spent a lot of time kind of partnering with C-suites and boards and educating them how to undertake smarter, faster, less dilutive financings. And to be clear, Third Creek, I always want to be clear about this. We're not a broker-dealer or a banker or finder, et cetera. I just work behind the scenes with these companies to kind of overhaul their approach to capital raising. And it's I'll just give you a quick example. It's always easier to just speak by example in these fronts. Here's a fact pattern that I see regularly. I'm dealing with currently a client. Retained my firm, MicroCap company, and after having consulted with a few bankers, they were pretty sure, based on the preliminary banking assessments, that they would be able to go out and raise $10 million in a common stock pipe. They didn't have a shelf available, so it was going to be a traditional pipe. And upon receipt of some of that preliminary advice from bankers, the company started crafting their annual operating plan, and that was based upon the receipt of $10 million from this prospective raise. And after a pretty extensive assessment of the deals that peer companies had recently undertaken, not only that, looking at their business, looking at their track record of capital allocation and their capital markets profile, their cap table, et cetera, I told them that the data suggests that they were actually way more likely to raise $5 million, and it was also likely that it was not going to be a common stock deal at all. And obviously this was news to them and pretty different from what they had been told, by these banks. And fortunately, I was able to get to them before they had relied too much to their detriment on, frankly, what was pretty bad banking advice. And then I set out to help them hire a bank that had the most experience in the market with small structured pipes in their industry, kind of most recently, and then help them negotiate the terms behind the scenes and close the financing. So, obviously having negotiated lots of structured deals on the other side of the table, I have a perspective on where the bodies are buried. And obviously not speculating about that, since we participated in hundreds of financing. So that's an example, just on the capital raising front. And look, make no mistake, Bobby. I mean, capital raising, issues for small public companies like capital markets and corporate finance issues are key governance issues, full stop. I mean, most people's eyes glaze over when you start talking about corporate governance because they think they're about to get a lecture from some lawyer about Delaware law. But, the reality is, for small public companies, that's absolutely a front burner corporate governance issue. If you don't have capital inside your company and you need it to survive, that's a big governance issue, right? So that's an example of, kind of the hypotheticals that I end up, getting involved in.
So, Adam, I'm about to take a whole big step back because, we're as people might have probably guessed at this point, the topic today is corporate governance. So, I want to get like a clear definition, like just either a one or two liner. Adam, what does this term mean, corporate governance, and then why is it important to keep in mind when you're looking at a microcap company as a potential investment?
Sure, and I think listeners are going to really benefit from this, Bobby, because there's so much misunderstanding about this. I think, first of all, unlike in private companies, right, where board members are sometimes either more just advisors to the CEO or people who are supposed to be able to open up doors for business relationships, the central role of a board of a public company is completely different. So in the simplest terms, the board of directors of a public company is principally there for two reasons, in order to keep it really simple. The first is to oversee that management is really executing on the company's strategy, and the second is to hire and fire the CEO. And a lot of people know the second one, not quite as clear on the former. And when you're talking about overseeing strategy, that's obviously a multifaceted oversight, right? In order for companies to execute on their strategy, what do they need? They need to have the right people, right? They need to compensate them appropriately. They need to make sure that those people are involved in a culture that's focused on, legally and ethically achieving all of those strategic goals. They need to manage those key risks to achieving all of those strategic imperatives, right? All these companies have kind of key enterprise risks, and they need to do all of those things in such a manner that drives long-term shareholder value. So again, in public companies, the role of board of directors is to oversee management on behalf of shareholders. And it's also really important, for your listeners to recognize that governing companies is different than operating them, right? Directors can poke their noses into the business, but they need to keep their fingers out, if that makes sense. And I'll give you an example just to answer your question about, kind of why it matters so much. And it's not going to be a microcap example, but it's an example that everyone in the United States is familiar with, but probably not from the governance standpoint, and that's Lehman Brothers, right? So Lehman Brothers had an enormous financial bet on derivative instruments. Fascinatingly, though, there were exactly 0 board members that were experts in derivative instruments at Lehman Brothers. So if Lehman had a board with directors who really understood derivatives, they could have been able to more objectively oversee that risk on behalf of the shareholders rather than just relying on what management was telling them, which, as it turns out, of course all of us know, wasn't really great, what they were hearing from management. So, and here's, kind of the second real-world way to kind of put governance in some perspective, and that is, think about it in the negative, and that is, if corporate governance weren't absolutely critical to every size public companies, there definitely would not be $200 billion under management by shareholder activists, since governance is at the core of about 60% of activist campaigns, right? So, it's really important for people to understand, and as investors, you could argue that there's not a lot of things that are more critical than who's on their board. I mean, ask some investors in Lehman Brothers what was more important than that.
Okay, so as a microcap investor, what are some of the qualities that I should look for, or we should look for, in a microcap board of directors as a whole and individually? What are some of the positive and negative qualities, and why is there sometimes a change to a board member?
Yeah, and look, and this is not necessarily microcap specific, by the way, and so whether it's a microcap board or a larger public company, there's really, I think the easiest way, again, just from a high level, especially for those of your listeners who are kind of new to thinking about corporate governance, there's two central qualities you want to look at a high level. The first is board composition, and that's a fancy way of saying who's on the board and why. And every company, and here's the easiest way to think about board composition. No matter whether you're literally like a corner delicatessen or whether you're Intel, every company has a handful of key strategic imperatives that they're trying to execute against. They probably have some key risks in achieving some of those strategic goals, and they also have some key customers, people that they're selling, entities that they're selling their goods and services to. And why does that matter? Well, the backgrounds of the board members should pretty much match up to those goals, risks, and customers. For example, just think about it in terms, again, of a hypothetical. If you have a little technology company that's selling banking software to enterprises in a heavily regulated market, you would want to see board members there with banking backgrounds, with software backgrounds, with regulatory backgrounds, and enterprise experience. And so, put a little differently, again, just think back to the Lehman Brothers situation. Boards just can't oversee businesses that they don't understand, right? Full stop. Mm-hmm. And I said there are two qualities, central qualities. The second one is really whether the board is objective. And what do I mean by that? Well, boards, when you think about boards like Apple or again, Intel or, some of the largest public companies in the United States, the board members at those companies are predominantly chosen by other board members, not principally by the CEO. And the reason for that is it's to avoid the CEO essentially choosing people to oversee him or her that are their friends, right? I mean, if all you do is let the CEO choose who's going to be on their board, it creates kind of a weird conflict because the people who are supposed to be overseeing you shouldn't really be your pals. It's pretty challenging to monitor your pals. So I think the moral of the story is really a lot simpler than a lot of the corporate governance articles that you read, and certainly a lot that are written by lawyers, which kind of wildly overcomplicate the issue. But from an investor standpoint, the more objective and the better comprised the board, the better chance you have for value-added oversight. And again, that oversight, the board is there on behalf of the shareholders to oversee what's going on at the company level. And when board members are either not terribly objective, or they don't have the requisite expertise, or they also aren't sufficiently engaged, i.e. they're kind of checked out or not paying attention, they risk the shareholders voting them out, or they risk other directors basically encouraging them to leave the board, which, by the way, should happen a lot more often than it does.
So I have a quick follow-up question to that, actually, because I've seen some press releases that microcap companies make where they're and they expect it to be this huge monumental press release where they put out something that they have a new board member who is the former attorney general to this, or the former CEO of this large Fortune 500 company, and yet I can't help but sometimes be skeptical of, like, all right, so are they actually doing anything? I mean, what do you say when you see something like that? I mean, obviously it might be transformational for the company, but as an investor, how should I take in information like that?
Yeah, good question. I think on the one hand, you could certainly, viewed in the most positive light, you could view that as being a potential positive for the company, right? I mean, investors certainly would view that as, gee, why is Mary or Johnny, Fortune 100 CEO, joining the board of my little $12 million company? Presumably they see some value there. But you're absolutely right. On the flip side, you should take that with a pretty healthy dose of skepticism for two reasons. One, are they actually really hands-on? I mean, they're presumably pretty busy people, so are they really hands-on and working hard on behalf of the shareholders? But I would argue even a second point is perhaps more typical, and that is, query how relevant the experience is of someone who operates a $200 billion company with governing a $10 million run rate company, right? Are they really going to be experts necessarily in some of the unique challenges that a really diminutive public company faces? And are they going to be prepared to be on a board where there's very little in the way of corporate governance resources, there's very little support staff? So a lot of times, when you add someone from a large or mega cap kind of situation to a nano or micro cap company, those aren't always marriages that really benefit shareholders, right? So they can, right, to your earlier point, they certainly can, but a healthy dose of skepticism is appropriate, certainly in my experience as an institutional investor. It's a good question.
So well, thank you. So I also want to know, what happens when the board becomes completely uncooperative?
Yeah, well, remember, it's important to remember, Bobby, that a board of directors, and I get this question sometimes when I speak around the country, a board of directors' role isn't really just to rubber stamp what the CEO would like to do, right? I mean, their role is to serve as fiercely independent overseers on behalf of the shareholders. So, there's two different groups here, two different constituencies, right? I mean, a CEO could feel like the board is making bad choices, and in that situation, a CEO has two choices. One is to try and really meet extensively with the board collectively and or also individually with the board members and see if he could get them to change their mind. But their principal prerogative in those situations really is to resign. I mean, that's really a CEO's prerogative if he or she feels that the board is making bad choices. If the shareholders feel like the board is making a bad decision or a series of bad decisions on behalf of them, then their principal avenue of redress really is to elect a new slate of directors. Because ultimately, even though boards can appoint directors in between shareholder meetings, it's ultimately the province of shareholders to elect directors who are going to represent their interests. So again, I mean, if a CEO really feels like a board's being uncooperative and making bad decisions, the nuclear option for them always is to resign, and for shareholders, their prerogative is really just to elect new directors.
Okay, so going back to one of your previous answers, you actually referenced shareholder activists. Firstly, maybe do a quick definition about what that means to be an activist investor, and is that also a realistic concern for most microcaps?
Sure. I mean, the quintessential activist investor is the one you kind of hear about, on a daily basis, reading the Wall Street Journal or watching CNBC, which is somebody like Carl Icahn, right, who will buy 5% of Apple and really kind of agitate for changes. I mean, he's been in and out of Apple several times, but one of the situations he was trying to convince Tim Cook and the board of was, hey, you guys have all this capital, you need to start returning some of that capital to shareholders because you're probably not going to do anything with $200 billion, so give back $50 billion of it, right? So that's an example of an activist where an investor will buy a stake in a company, and their goal is, rather than passive, like maybe like a Fidelity mutual fund where they if they really don't like what's going on, they'll just sell their stock. Rather, they will kind of actively try and change what they don't like in order to try and unlock value. And getting back to the way that all of us every day get our news, and it's important because we all get our news predominantly from tier one media like the Wall Street Journal and CNBC and Bloomberg. And interestingly though, those tier one media outlets, they virtually ignore it, as you know, Bobby. They ignore the micro and the small cap world. And so whenever there's any kind of conversation about shareholder activism, the only people you ever hear about are people like Carl Icahn or Nelson Peltz or Bill Ackman, et cetera. But not to inject too much reality into this conversation, but shareholder activism in reality is really a micro and small cap phenomenon. And so it actually is very much a concern for micro cap companies. And I'll just give you a statistic from Activist Insights, which is an industry magazine that covers shareholder activism. And it really is exactly at loggerheads with what most people think. Again, if all you do is read the Wall Street Journal and get all your news from there. And that is, in 2015, 74% of activist campaigns were actually in micro and small cap companies in 2015 in the United States. And so, and there are two reasons for that, in fairness. One of them is math. And when I say math, I mean it's a lot cheaper to buy 10% of a $200 million company than it is to buy 10% of a $200 billion company, right? So there's the math perspective of the reason why there's the overwhelming majority of activist investing is really in micro and small cap companies. But there's another reason, and that is that, frankly, there is systemically poor corporate governance in the micro and small cap world, and so there's a lot to fix, frankly, and there's a lot of value to unlock if you are going to actively roll up your sleeves and kind of get involved. So, yeah, I mean, activism is definitely an issue for micro and small cap companies, and I hear from those companies 2 or 3 years ago, maybe one company a quarter would contact my firm to kind of get a sense of, a buy-side perspective on this. Now I'd say it's probably once or twice a month. So it's, that's of course anecdotal, but still, it's clearly a micro and small cap phenomenon.
Well, is it a concern for investors or for microcap investors, or like how should they take in that information? Like how should I like when you said that, I'm thinking to myself, well, if the company hasn't really been performing, all right, if this guy wants to come in and do something, okay, all right, fine, But
yeah, I think there's two constituents, right? There's the company and then there's the existing shareholders, right? And so from a company perspective and standpoint, they should be pretty trepidatious. And just to be clear about shareholder activists don't show up at companies for no reason, right? In the history of capital markets in the United States, corporate governance scrutiny is always inversely proportional to corporate performance, right? So it's poor performing companies or companies that are performing poorly compared to their peer companies that activist investors show up at. And so if you're a C-suite person there or you're a board member, yeah, you probably, if your company is performing poorly compared to your peer companies, you probably should be pretty trepidatious about the fact that those folks are going to show up. And if you're an existing investor, I'm not sure, it's probably a little dramatic to say that, the cavalry is on the way, but if you're an existing investor, you might frankly kind of view it that way because it's likely that other investors out there will view it as a potential positive if activist investors show up in order to optimize corporate governance, figure out a way to unlock value. So oftentimes, not always, but oftentimes, it certainly can help you if you're an existing shareholder.
So this actually leads into my next question, and it's probably, your answer is probably why the activist investors or shareholder activists do show up. And what I want to know now is, where do most microcap boardrooms underperform, and are there any other common governance shortcomings?
Yeah, so sometimes my answers to questions like this aren't terribly popular, but they're always very frank. And look, from not only from my experience as an institutional investor for a long time, but also as someone who advises an awful lot of these companies. Here's the thing: a lot of microcap corporate governance underperformance can really be traced to the CEO. Why? When CEOs intuitively feel that corporate governance is kind of a form over substance waste of time, which you get a lot when you speak to micro and small cap CEOs. They believe it's just not a great use of time, that their board is not a value-added board. Then what are they going to do? Well, they're going to kind of default to what I would characterize as governance light, right? And that means they're just going to install a few of their friends on the board, and as a result, governance is going to be poor. And in that regard, Bobby, it's kind of like, if you have friends that are software engineers, I'm sure you've heard the expression garbage in, garbage out, right? And when you're the CEO of a company, if you believe that governance is a waste of time, then it's likely going to be a self-fulfilling prophecy, right? Because you're just going to put your friends on the board and people, acquaintances, and it's just not going to be meaningful oversight. So, when CEOs feel that governance on the flip side is important, then at least the company has a chance to have real oversight that can add value for the shareholders. So, board composition, again, which is something that we chatted about a bit. Having the right people around the table with the right experience definitely is a big problem. Also, the objectivity of those directors is a big problem. Again, if they're all just friends of the CEOs and naturally inclined to agree with what they have to say, you're not really going to have meaningful oversight. Last, I'd say that, and this is something also that some people don't like to hear, but I think it's important to kind of get it out in the light of day, and that is remarkably few microcap board members are actually shareholders. And look, this is just, it's a material problem, full stop, for most institutional investors. And obviously, look, from a buy side perspective, stock options don't mean anything, right? And that's something that is a big disconnect out there. A lot of times when I was an institutional investor, board member CEOs would regale us with the fact that they have so many options, so they have a lot of skin in the game. That's not skin in the game. Skin in the game is cash, right? And so, interestingly, if you're at a mid or large cap company in the United States, they have what's referred to as stock ownership guidelines for board members, where they are typically required to own some percentage of their annual cash board stipend in stock. So, for example, if you're a director and you get, let's just make it easy, say you get $10 a year. If you're a board member at Coca-Cola will say, look, over the course of 3 years where you would have gotten $30, we would like you to take own 2/3 of that amount, or $20 in stock over a 3-year period. And by the way, for the entire time you're on the board, you can't sell the stock, and you can only sell the stock after you leave the board. That's what a stock ownership guideline is for a board. And I will tell you, and I know that a lot of small company people may not want to hear this, but not only do very few microcap companies have stock ownership guidelines, but rest assured, those requirements are on the way. I mean, they are making their way down, sure as day follows night, from large companies to medium-sized companies, and the next stop is small and microcap companies. So at some point, over the next few years, this issue is going to get solved, because investors are going to expect that microcap directors have actually ownership positions in the stock. And I certainly always look for that, and I think that all investors should look for it. They should look for not only management teams, but also board members to actually have a stake in the company. Stock options, again, pardon me, definitely not skin in the game to any institutional investor in the United States.
I was just going to say, one of the other press releases that I see a lot when it comes to board of directors is, and especially on all the message boards and everything else, is when a director goes in and actually voluntarily buys more stock. So I've always seen that as something kind of interesting, and as something where it's like, oh, here's a board director that actively believes in the story potentially, and wants to go in and buy more stock to, add to their own personal positions. I mean, can you comment on that?
Yeah, well, that's, again, whether you're forced to or whether today most, the overwhelming preponderance of micro and nano cap companies are not those directors are not forced to, certainly by any measure. But when you see that voluntarily, you always look at that positively. And look, I mean, it just stands to reason, right? Getting all the way back to one of the first questions you asked, which was what's really the role of a director, and the role of a director is to oversee management on behalf of shareholders. Presumably you're going to engage in a lot more active oversight and a lot more objective oversight if you also happen to be a shareholder, right? So it's not an accident that the largest institutional investors in the United States have, of course, demanded that mid and large cap companies have these stock ownership guidelines for directors, and they certainly believe that helps governance. And so whenever, when it trickles down to the smaller public companies, to your point, when you see that, I think investors should. I mean, in and of itself, is that a reason, is that a buy signal? The answer is no, but I think everyone should be mindful, as you said, that, hey, here's someone on the board of this company that obviously is putting their money where their mouth is, and that's, potentially something positive to keep in mind when you're looking at investing or increasing your position in a company.
Okay, so on that note, what can we do as investors to better know what we're getting on the corporate governance front with microcaps?
Yeah, so here's kind of I'll give you kind of a brief 3 or 4 part answer that's kind of the $100,000 question here, and this is something that these are things that every microcap investor can do. They're simple, and in my belief, absolutely must do. The first is, look, we were talking about board composition, earlier. You have to read the director bios on the company website, and then you need to ask yourself whether the backgrounds of those directors match up to the likely strategic imperatives of the company, the likely key risks that those companies face, and also the customers that they're selling to. Remember earlier, I gave the example of Lehman Brothers, gave the banking software company hypothetical. If the backgrounds don't line up with the kind of strategic imperatives of the company and the key risks and the company customers, then that's a big red flag. Second, if the company is SEC reporting, and of course we know that there are companies listed on OTC markets or pink sheets that aren't, but if the company is SEC reporting, look in the annual proxy, and it's really easy to find. It's always it always says DEF, the definitive proxy, DEF. In the SEC filings. Look at the annual proxy, and it'll tell you how long the directors have been on the board. Why does that matter? Well, when most of the directors of a company have been on a board for more than 10 years, that's also a red flag. And why? Because, getting back to what we were talking about with board composition, goals and risks and customers all change, right, with companies. It's not static. So boards should be regularly refreshed, and when you have the same board members on a board and all of them on the board for double-digit number of years, that's a big red flag. Board service is definitely not a lifetime job. The third, if you have a chance to meet with the CEO, perhaps at an investor conference, ask him or her how each of the board members came to the board. And if he or she personally invited each of them, right, we get back to one of the things I mentioned earlier, which is, look, it's a fair question to ask the CEO and then really listen to the answer carefully, which is, hey, if their role on the board is to oversee you and the rest of your management team, how are they possibly going to be objective in their jobs if they're basically all of your friends and acquaintances, right? And just listen really carefully to the answer. And the last one is, if you have a chance to speak to some board members, which, by the way, is a lot more common now than in years past, certainly in the mid and large cap space, it happens every day, and in the small cap space is starting to happen with regularity. Certainly with what I used to do, which is special situation investing. Ask the directors, also how they got on the board, and again, listen pretty carefully to the answer, and then ask them how, as a board, and this is a little more granular but important, ask them how they collectively benchmark the success or the failure of some of their strategic goals or capital allocation. For example, if you're going to build a new factory as a board, how do you benchmark internally whether that factory is succeeding or failing, right? Because the biggest issue, of course, for micro and small cap companies oftentimes is capital allocation, meaning you continue to allocate more and more capital because the management team says we need to do that. But the reality is that the reason why that happens is because you have a board that hasn't really benchmarked any of the success or failure quotients of that exercise. So again, if your central strategic imperative in your company is to operate a factory efficiently, a great board member should be able to tell you immediately without missing a beat, hey, here's the way we benchmark the success or failure, here are the metrics that we use, and if it's not a great director or not a great board of directors collectively, they're going to look at you like you just asked a question in a foreign language, right? And so if you do get in front of a director, those are two great questions that you could ask them. So, but yeah, great question, and something that I think that, as you were saying earlier before we got on the phone, Bobby, that you had some people that were asking, specifically about corporate governance. People are starting to get a lot smarter, and it's terrific that they're getting a lot smarter about this in the micro and the small cap continuums.
All right, here we go. Not that we haven't had any a lot of fun already, but this is one of my favorite questions, and I always have fun hearing the answers. So, Adam, do you have any stories, without using the names of the companies, or you can if you want, just make sure you disclose whether or not you currently are a shareholder or not, that maybe taught you the importance of putting together a solid board?
Sure, and in fact, I'll definitely name names, right? So in 2014, there's a really well-known activist hedge fund called Starboard Value, run by Jeff Smith. Jeff Smith, by the way, used to be in the micro and small cap continuum. He was one of the guys who ran Ramius. Those of you who are involved in the small cap special situation world for a while certainly know Jeff or know Ramius. But Jeff runs Starboard Value, and in 2014, Starboard waged a proxy contest against Darden Restaurants. And some of you, that name is not going to ring a bell until I tell you that Darden is the New York Stock Exchange listed parent of Olive Garden, the one with all the breadsticks, the restaurant. And so Starboard, in their proxy contest, they basically argued, a lot of what we're talking about here today, by the way, they argued, look, not only is your stock performing horribly for years now, but literally every single board member should be replaced because you just have the wrong people around the table. And the analysis they went through, by the way, not grossly dissimilar from what we were talking about with our little hypothetical about the software company. And Starboard then did something that doesn't happen very often, frankly, when investors seek to remove an entire board, not just one person, but every person. They actually won. And so they replaced every single board member. And that was in 2014. And since then, Darden's stock, Darden again is the New York Stock Exchange listed parent, has gone up over 50% since Starboard's new slate of directors took over. So anybody who believes that the link between board members and shareholder performance is a weak link, try and explain to me Darden Restaurants. The second example I'll give you is kind of the flip side, and I'll also name a name, and one that's been in the news almost every day, certainly for the last few weeks, which is Theranos. Theranos is that VC-backed company that was touting to the world a new kind of less intrusive, if I understand it correctly, cheaper way to do blood tests, right? And they're the ones, I think, that had the strategic relationship with Walgreens. Anyway, you would think, again, hearkening back to the conversation about our little software company or even about Lehman Brothers, you would think that they would have a board that was filled with, we could write it down right now. Even with all of your listeners, we can all write down who should be on Theranos' board. There should be a bunch of scientists, blood experts, lab operators, right? When you think about the business they're in. But when you look at who's on their board, everyone would have been wrong, right? Because who was on their board? Well, Henry Kissinger was on their board. George Shultz, right, former Secretary of State. Exactly nobody who understood anything about the key risks, really, and the strategic goals and the customers of the company. And so, anyone who's been following Theranos in the news knows that, this company is under all kind of governance and regulatory scrutiny. Walgreens canceled their relationship with them. And so, if ever, Bobby, there were a cautionary tale on corporate governance, that's definitely it, right? As a perfect example.
Do you have a microcap example? I want to hear one in the microcap space where, I don't know, either on the positive or negative side, either one doesn't matter to me. But I want to hear one like in microcaps that has happened.
Yeah, I come across this all the time. But I recently was speaking with a company that has is an industrial process company, and they're not exchange listed. They're an OTC company, and And this company, is looking to do a financing, and I said to them straight away, they thought that most of my comments were probably going to be about the balance sheet and some other issues, and I said, and I won't speak specifically about the process because people will be able to reverse engineer who I'm talking about, but it was a very sophisticated kind of machine processing company, and I looked at their board. They had, I'm going to exaggerate a little bit, but they had a friend of his who is in commercial banking, who works literally in a branch office of a local bank. I'm not sure he's a bank teller, but works in a local bank. Had person who was a money manager, someone who was a stockbroker. They had someone else on their board who was who owned a chain of dry cleaners. Right, and then the CEO, and I just said, you are selling, if I understand this correctly, to utilities, right? And this process and this machinery that you have is hyper sophisticated. You have no engineers, you have no scientists, you have nobody that understands how to sell you to utilities because you have nobody on the board who's ever had any utility experience. How are these people? How do these people understand your business sufficiently to actually govern the company? Yeah. And just silence. He just said, "That's a good question." And he said, "I've never really thought of my board that way." And frankly, and by the way, just to be clear, I'm not being pejorative about this company at all. This is actually fairly common. The CEO is a really smart guy, and their company is a pretty sophisticated engineering type company. But the question is a fair question. And by the way, this is the type of question that we used to undertake, question and answer that we used to undertake as institutional investors over and over and over again. And in fairness, this particular CEO, by the way, in addition to being a really smart guy, this is his first time operating a public company, and no one ever said anything to him about it. No one ever really, commented about it. And his view when I said it to him was, "Wow, that's really interesting. I never thought of it." So, that's part of the reason why these kinds of conversations, Bobby, are important because there's an educative piece to this, right? There are a lot of well-meaning CEOs out there that just don't understand, what a board's role is, and there's just not enough frank dialogue to explain it. And there's also not a lot of investors in kind of really, really small public companies that understand the importance and can kind of triangulate, kind of comparing something like Theranos or something like Darden Restaurants to their little companies. It's an exact match. There's no such thing as it mattering a lot in big companies but not in small companies. It's exactly applicable.
Okay, we're at that point where I want to know what is your advice then for new microcap investors when doing their due diligence on board of directors of these companies, and where can you find that information on them if to look a little bit deeper than just say like reading their bios on the company website?
Well, I'll answer the last part of that first, and that is, you really have to be able to question the officers and directors of the company directly, and so to the extent that you can go to investor conferences where they're presenting and be able to ask questions. If for retail investors, that's a little more challenging to kind of convince a CEO to sit down with them, but you certainly can ask their investor relations people and try and get answers to those questions. But I think, look, in addition to some of the earlier comments and some of the suggestions, the kind of four-part kind of suggestions on this front, I would just leave you and your listeners with the following comment, and that is, microcap corporate governance, as I alluded to earlier, kind of often either soars or fails because of the CEO and kind of their pre-existing beliefs about the merits of whether kind of really fulsome, objective corporate governance is a good use of time or it isn't. But I'll just give you a question, and this is a question I certainly invite everyone to ask because I think it's a fair question. And this is a question that I used to ask microcap CEOs, and I still do when I meet with them. And it's this: BlackRock and CalPERS, right? CalSTRS. You look at those three entities; they manage trillions of dollars, right? Not billions, trillions of dollars. And what do you know about those entities? Well, among other things, those entities happen to be laser focused on corporate governance. and then you ask the question, well, why is that? Well, the largest asset managers on earth, they know, right? They're not speculating. They know that better governed companies make more money. And I always repeat it. I always say to them, they know that better governed companies make more money. That's what people who manage trillions of dollars in the United States know to be a fact. That's why they're laser focused on corporate governance. Accordingly, if they are so sure that that's the case, why doesn't that apply to every microcap company, right? And so, what I tell microcap CEOs and investors that are listening can take away from it what they will. But what I tell CEOs after asking them that question is simply this, and that is, if you're the CEO of a microcap company, you have two choices as it pertains to corporate governance in 2016 and beyond. Number one, you can either really optimize your approach to corporate governance and make more money, because again, the guys who manage trillions of dollars know that better governed companies make more money. So choice number one, optimize your approach to corporate governance, take it seriously, have the right people around the table, and have them not all be your friends. Or number two, you can stick with your current approach, and you can have a shareholder activist come in and fix it for you. And by the way, with respect to number two, when the activists actually fix your governance, you and your current board are going to be on the other side of the door when they're done. Right? So those are the two choices. There aren't any other choices. And especially since a lot of your listeners and others, I've given at least 70 keynote speeches around the world on this, and the level of understanding of corporate governance in the micro and small cap in that continuum is just rising vertically. People are really starting to understand, as they should. So, hopefully some of the commentary today, simplifies it, most importantly, and kind of clarifies, gives everybody some basics on what they could be looking for. You definitely don't have to be BlackRock or CalSTRS or CalPERS to be able to do some of the basic diligence that we've been talking about at all.
Okay, Adam. So where can our audience go and find more information about you and Third CreekAdvisors?
Couldn't be easier. It's just thirdcreekadvisors.com. So it's third as in first, second, third, creek as in a little river, and then advisors, ADVISORS.com, all one word, Third Creek Advisors. And there's a lot of resources on the website. Again, since I'm the only person really in the United States that's focused on small cap corporate governance, there's a lot of articles. I've written articles for Business Week, for NASDAQ, for all kind of different publications, hedge fund publications. So there's a lot of resources, I think, for investors as well, just to be able to kind of understand and get smarter on some of those issues, and also, of course, for companies as well.
Adam, thank you so much for joining me on the Planet MicroCap podcast, and I look forward to seeing you soon at an upcoming event.
Yeah, likewise. Thanks a lot for having me, Bobby.
No, thank you. Thank you all for tuning into the Planet MicroCap podcast, and thank you, Adam, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN.Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap podcast. Have a great 4th of July weekend, everyone.